The story of perpetual bonds, do they last forever? Bonds explained. Imagine earning interest from an investment that never really ends. Sounds interesting, right? Today, we're going to explore whether perpetual bonds truly last forever and what makes them unique in the world of investing. A bond is like a loan you give to a company or government. They promise to pay you interest regularly and return your original money after a certain period. Regular bonds have a fixed date when the issuer pays back your initial investment. But perpetual bonds are different. They don't have a set date to pay back the principal. Instead, they keep paying interest, called coupons, forever. Perpetual bonds are a special type of bond that can, in theory, last forever. They only pay interest, and there's no fixed date for returning the original money. However, many perpetual bonds include a feature called a call option. This gives the issuer the right to repay the bond after a certain time, like 10 or 20 years. If they choose to do so, the bond ends, and the investor gets back their principal. But if they don't, the interest payments continue indefinitely. Companies or banks might issue perpetual bonds to get long-term money without worrying about paying it back soon. These bonds give them steady capital for many years, helping fund big projects or expansion plans. For investors, perpetual bonds offer a consistent stream of interest payments, often higher than regular bonds because of the risk involved. They're attractive if you want ongoing income, but you must remember that you might never see your original investment again if the bond isn't called. Since perpetual bonds don't have a maturity date, they technically can last forever. But the call option means they might be redeemed early if the issuer decides to pay back the principal. If not called, the bond continues to pay interest forever. That's why they're called perpetual. They can go on for a very long time, but not necessarily forever. There are risks to keep in mind. If the issuer faces financial trouble, they might stop paying interest. Also, market interest rates can change, which affects the bond's value. If rates go up, the market price of the bond can drop because new bonds might offer higher interest payments. Selling a perpetual bond can sometimes be tricky because there's no fixed end date, making it less liquid than other investments. In summary, perpetual bonds are a unique investment vehicle that can last for an indefinite period because they pay interest forever unless the issuer decides to pay back the principal early. They provide a steady income stream but come with risks like no guaranteed return of the original money and potential market fluctuations. Understanding how these bonds work helps you see the different ways to grow wealth through investing.